Good afternoon, everyone. My name's Chris Andrews, Vice President and Head of Funds Management here at Trobe Financial, and your moderator for our session today. We're really pleased to welcome a large number of people from across Australia today, so good afternoon, or should I say perhaps good morning, depending on where in this great country of ours you are. We greatly appreciate your interest and ongoing support in our investment operations here at Trobe Financial. And in particular, we'd like to welcome our New South Wales attendees. Obviously, New South Wales is going through a difficult time with the bushfire, so our thoughts go out to you today. Now, the purpose of these quarterly investment calls, of course, is to provide you, who are our business partners and our investors, with a regular forum so that you can receive the most recent information on really three key areas of Trobe's operations. Firstly, our house view on the economy, so that's both here and overseas, a tailwinds versus headwinds analysis, if you like. And you can see how that affects your investments in our chosen asset class. Now, secondly, of course, we'll look at a review of Trobe Financial. We'll call it a quarterly health check, if you will. We'll cough and you can listen. And thirdly, we'll look at our investment offerings and their performance in comparison to the market. Now, obviously, it's important that we're seeking to provide this information in an interactive forum so that you as investors and investment professionals can have the opportunity to ask questions in relation to the matters that I'm going to discuss today. So the focus of these calls is not in relation to individual assets or investments. I won't be commenting on those today. But of course, at Trobe Financial, we're happy to take calls afterwards on any of these issues. And our investor sales team is, of course, standing by right now, ready to take any calls on those issues on our toll-free number, 1800-818-818. And we've got plenty to get through today, and I appreciate that you're all on very tight schedules, so we'll aim to keep this presentation to half an hour. Firstly, we'll have a look at the agenda. So the topics that we're going to cover today are on screen. First, we'll review domestic macroeconomic issues and their impact on our investment performance. We'll focus in particular on issues like interest rates, credit growth, housing prices, and key economic indicators and drivers like unemployment and inflation. Obviously, all of those have a significant impact on the outlook for investors. Secondly, we'll have a look at the international economic outlook. Third, we'll review the Trobe Financial Group and its performance, and then we'll have a look at how our retail investment fund in particular has performed for its investors. Finally, I'd be delighted to take any questions from you. Now, you should see on your screen where you can type in questions that will come through to me. Obviously, with the numbers we've got attending today, may not be able to get through all of the questions during the half hour that we've allotted for this session. So we'll answer questions on the, I guess, cab rate principles, first come, first served. If there are any questions I can't get to for time reasons, then of course I'll follow up with you personally after the teleconference. So we turn now to macro issues, and overall we think this year is one of cautious optimism as the Australian economy continues its positive growth story. One way to have a look at this is to consider the headwinds and the tailwinds that are either pushing our economy forward or holding our economy back in the well, I guess the next 12 to 18 months. And there really are 5 key headwinds. The first, obviously, is the China story. It's been much written about, much agitated. China's growth is slowing. There's no doubt about that. It's not unexpected. It has to happen, in fact, as China's economic development continues. And we're still talking about something like 7% growth per annum on really what is an increasingly large base economy. Still, there's little doubt that the heady days of above 10% growth are finished. So those companies that sort of require that sort of growth and demand out of China are going to struggle. The second headwind is the Aussie dollar and its persistent strength. Now, despite hints that monetary policy is targeting our exchange rate, we'll talk about that in a moment, we just can't get the Australian dollar down. In fact, this morning, as early as this morning, it broke through 97 US cents once again. Now, obviously, this takes a massive toll on our exporters and also on industries like tourism. So these sectors are going to continue to find things really tough while the Australian dollar remains so high. Third headwind, third thing holding us back is credit growth, and frankly it's quite low, especially in comparison to what has happened over the last generation or so. Again, I'm going to look at this in more detail in a moment, but there's no doubt that we're looking at substantially lower credit growth than what we're used to, and as an economy we're just going to have to adjust to that. Fourth, and a result of what we've the previous 3 headwind factors, I suppose, is our GDP growth at 2.5%. Now, Obviously, we shouldn't be too greedy. We've done better than a lot of the world in recent years and continue to do so. But the facts are we are below trend growth, and that's widely acknowledged by people like the Reserve Bank, Treasury, pretty much every economist would acknowledge that we are below trend growth. Really, we need to be hitting around 3.25% for our economy to be in a steady state. So we are seeing that as a drag on performance, not just for the economy, obviously, but also for investors. And then finally, we've got the political turmoil over the last few years that really has highlighted the problematic role of the government in the Australian economy. Is it a help or is it a hindrance? Now, that obviously embraces a whole range of topics. What should our level of debt to GDP be? Are we over-regulated? Are we under-regulated? Some would argue perhaps we are. Should the government be the centre of the economy, or should private enterprise? Now, these are all massive questions and part philosophical, so I'm not going to resolve them all today. But obviously for investors, the recent period of turmoil in the political sphere, it's been a drag on economic and investor sentiment, and it needs to improve. On the other hand, the tailwinds are there, and to be fair, they are quite considerable. We have the lowest interest rates in 35 years. Now, that is a mixed blessing, of course. It's great for borrowers. It strengthens their ability to meet their repayment obligations, but it's not so good for savers and investors, obviously, who are forced to chase yield from riskier assets. So we'll look at interest rates in a bit more detail shortly. We also see as a tailwind Australia's low inflation. Now, we'll look at this in more detail again in a moment, but price stability is critically important to the long-term future of the Australian economy, and we're currently achieving that objective. So that's a really strong tailwind for the Australian economy. We also have among the lowest levels of unemployment in the developed world. Now, admittedly, many are expecting it to increase in the next 18 months or so, and perhaps we'll end up with a 6 in front of it, but we still sit well below our friends in the Eurozone or the US, or for that matter, most parts of the world. Finally, we have more favourable demographics than many of our international competitors. We're still a relatively young country. We've still got a relatively reasonable birth rate and still solid immigration levels. So we've got positive population growth, which is continuing to drive demands for goods and services. So with all that factored in, all those headwinds and tailwinds factored in, we at La Trobe Financial remain cautiously optimistic about Australia's prospects in the medium term. So let's have a look at some of these issues in just a little bit more detail. First, to interest rates. Now, you might recall that on the 6th of August, the head of the Reserve Bank, Governor Glenn Stevens, announced that the official target cash rate would be reduced by 25 basis points to 2.5% per annum. That was a historic announcement. This is the lowest level in the modern era. Now, in making this announcement, Governor Stevens cited below-trend economic growth, increasing unemployment, coupled with inflation that was consistent with the medium-term target of 2 to 3% per annum, and inflationary pressures remaining, pretty restrained. Interestingly, he also cited an Australian dollar that remained at a high level and suggested that lower rates would help it depreciate over time and foster what he called a rebalancing of growth in the economy. Now, obviously, exchange rate management is not an explicit part of the Reserve Bank Charter, so this comment attracted some discussion. We would have liked to see a little bit more, but some discussion among economists. Most recently, at its monthly monetary policy decision on the 1st of October, the Reserve Bank decided to leave the rate unchanged, still at 2.5% per annum. Once again, Governor Stevens essentially reiterated his comments from August, so growth below trend, unemployment's edged higher, inflation is consistent with the medium-term target, etc., etc. Interestingly, the Governor for the first time noted that household and business sentiment has improved and that there are signs of increased asset values and demand for finance. Now, based on these very cautiously positive summary, our view is, and this is a little bit controversial, it's most likely that interest rates have bottomed. Barring any adverse developments, the most likely next move for interest rates is upwards. Having said that, we don't expect any dramatic move upwards for some considerable period of time. Now look, also arising out of the Governor's statement and of critical interest to investors is that the Governor acknowledged there is a continuing shift in investors' behaviour, obviously given the declining returns on what are described as low-risk assets. By the end of the September quarter, the average of the 12-month term deposit rate for the big four banks was just 3.38%. Now that's barely ahead of inflation at 2.4%. And after marginal tax rates, frankly, and investors really only just above water. And we don't see this improving materially in the medium term. Now these low interest rates, well, they're assisting the economy and borrowers who can more easily afford the loan repayments on their borrowings, But as we said, it's a curse for investors because it's forcing investors to chase yield to stay above the rate of inflation and obtain a real investment return. So that's interest rates. Turning now to credit volumes. There's been a lot of negativity in the press, no doubt about that. I think we've probably all read it in recent years about the low level of credit growth in Australia since the GFC. Obviously, the drop in growth from 15% in 2008 to the 3 to 5% range that we're seeing now is a pretty significant structural adjustment, to put it mildly, especially considering that the economy's had double-digit credit growth for the better part of 20 years. On the other hand, we have to question whether the system could support that double-digit growth in credit over the long term. So, in fact, if we have a look at this next graph, from about 1994 on, we see that the ratio of credit to nominal GDP in Australia grew from around 0.8% to, well, heading up towards 1.6, 1.7%. A key cause of this, of course, was Australia's demographics. Now, if we put it really simply, during this period, so the 1990s and 2000s, baby boomers were at their peak earning capacity, and Australia's dependency ratio, which is obviously the number of tax-paying workers to retirees, was at an all-time low. We were in a demographic sweet spot. The nation was therefore uniquely positioned to gear up and grow its wealth. Starting in 2010, however, baby boom generation began to reach retirement age. As a result, Australia's dependency ratio is now on the way back up, and we do not expect to see a sustained return to heady days of double-digit credit growth in the near future. We expect system credit growth to remain subdued, and look, overall, this is probably a good thing for the economy in the long term. We certainly don't see any signs at this point of a credit boom or a bubble where Australians collectively go on a debt binge. Now, Trobe Financial is probably aware we originate well over $1 billion in loans a year. So what we're seeing is steady, measured credit growth month on month. And frankly, we're pretty comfortable with that at this stage. All of that, of course, contributes to the creation of a marvellously stable, vibrant and growing asset class. Now, as you can see from the chart on screen, the residential housing sector alone is around $1.3 trillion, just a touch above. That's about the same size as the market cap of the Australian Stock Exchange, or, alternatively, the same size as the assets of the entire Australian superannuation system, just below them. So it's a really powerful, deep asset class with really a lot of opportunities for investors. And that, of course, raises the perennially controversial topic of housing prices. And before I get into the stats and figures, what the observed outcomes on housing prices recently, I want to make some initial points clear. First, we at Trobe Financial as investment managers do not invest in property. We invest in loans to borrowers that are secured by mortgages over property, and that's a different asset class. It's a debt, not an equity asset class. For us then, the interesting question when we look at housing is not so much whether property prices are rising quickly or slowly or are simply holding steady. The key question for us is subtly different, and it's are housing prices sustaining their value such that we retain sufficient security to protect our investors' positions in the event that a borrower goes into default. That leads to the second point. We are not property bulls. Make no mistake about it. We've got what I call a great conviction in the enduring strength of this asset class. We've seen its consistently low volumes for investors. We've seen it weather storms like the global financial crisis that left markets like equities floundering really for years. But our conviction is rational. It's based on observable performance. It's not based on faith or a need to get properties out the door. Notwithstanding what market commentators are saying from time to time about the prospects of the property market, every single loan we do is supported by a valuation from an independent professional valuer. It keeps it empirical. We're not talking a faith-based investment here. So that's our investment philosophy, and with that said, let's take a look at the results we're seeing. First, and we've got to make this clear, the housing market's got a number of commentators who regularly assess movements in value. Each uses a slightly different methodology, and these methodologies all have their own unique strengths and weaknesses. At Trobe Financial, we keep a watch on each of them. So the Trobe Financial 3 Index Average, which is what you're seeing on screen, tracks the three biggest providers, being the ABS, the Australian Bureau of Statistics, RP Data Rismark, and Australian Property Monitors. As you can see, they collectively reported a 4.64% increase in national housing values to the year ending 30 June 2013. So that's the most recent data for which all three are available. The ABS is traditionally quite slow in releasing its data. September quarter data from the ABS won't be available till early November. Now, as you can see, underneath that headline figure, the results are actually quite variable across Australia. So you have cities like Sydney, Perth, Darwin and Melbourne all experiencing strong annual performance, and you've got Brisbane, Hobart, Adelaide and the ACT all much more subdued. And interestingly, there is quite a variance between the different indices, which really is why we tend to average them out to reduce the statistical noise. If I can say from an investment manager's perspective, we are not seeing anything to give us undue concern. Local markets will always perform differently depending on local circumstances. For example, we could see that Sydney house prices have been flat for a decade, so we're seeing the recent strong performance that Sydney's seeing, and it's probably ticked up since June as well. We're seeing that as a prime example of a market playing catch-up. On the other hand, you have a city like Canberra, it's obviously been seen as performing less strongly in some indices, and it's going to have probably a flat year as strong recent supply hits the market and soaks up demand, and also we see a focus on cost savings hit the public service. Now, as well as these, I guess, backward-looking historical value indicators, we also carefully watch leading indicators, things like auction clearance rates, which is spotty and volatile, but still a useful metric, and stock on market, which SQM Research report on extensively. All indicators remain very positive at this stage. Auction rates are consistently up year on year, hover around the 70-75% range in the key Sydney and Melbourne markets. Stock on market is also reducing in virtually every city, and that reflects demand soaking up the available supply. The only city experiencing material growth year on year is Perth. Sydney and Melbourne see a decrease in stock on market at 26.8 and 15.5% respectively. So fundamentally, as an investment manager, we continue to see an attractive economy producing strong borrowers supported by a stable property market, which is obviously what we like to see. Other macro issues affecting our asset class are, of course, issues such as unemployment and inflation. In considering these issues, we can see the softness from the charts on screen that's giving RBA the freedom to deliver such a historically low official interest rates. The unemployment rate, while still very low in historical terms, is up on its performance in the lead up to the GFC and is still on the rise. Look, and just as importantly, the participation rate is also dropping, so we'll continue to watch that metric closely. Meanwhile, CPI continues to display its normal volatility. However, it seems firmly entrenched in that RBA target medium-term range of 2 to 3% per annum. Now, the area we need to watch here is tradables versus non-tradables inflation. In essence, since the early 2000s, Australians have been importing low inflation via the purchase of goods and services overseas, aided by that strong inflation rate we were discussing earlier. Think cheap big screen TVs. However, non-tradable goods and services, which are those produced domestically, are consistently experiencing circa 4% inflation. Now, should we lose the inflationary advantage of a high exchange rate, we might find total inflation increasing quickly. And obviously the Reserve Bank is going to be watching that very carefully in its deliberations on interest rate policy. So that's domestic macro issues. Now let's turn to the international economy and reflect on that and its outlook for investors. Speaking broadly, we see a benign outlook for Australian investors, but we're going to see turbulence persisting for some internationals. Now, recent information is consistent with global growth running a bit below average this year with reasonable prospects of a pickup next year. Commodity prices have declined from their peaks but generally remain at high levels by historical standards. Importantly, the output indicators for China continue to be strong. So whether it's measured by electricity consumption, rail freight, crude steel or raw industrial production, China's output continues to increase and to increase strongly. Note again, though, we're not going to see those plus 10% growth rates that we experienced sort of 4 or 5 years ago. Inflation in most countries remains well contained. As is widely known, advanced economies, frankly, are in a reflationary phase as they attempt to build a sustainable economic growth by accommodative monetary policy. Developing economies are experiencing higher inflation. Now, in a country like India, that might be a bit higher than is frankly comfortable. Indications from China are a bit more positive. Inflation still seems to be very much under control there. There's no doubt that investors are going to continue to watch these numbers very closely, though. Obviously, there's been a lot of talk about wage pressures building in China, so China and its inflation story is going to be closely watched by investors in the coming 12 to 18 months. Obviously, if we're talking about international economies, we've got to address the US debt crisis. I'm not sure what we can add to the commentary, the extended, almost feverish commentary we've seen in recent days, so we'll just give a quick précis. The debt limit is set by the US Congress, obviously, and that represents the total value of US government borrowing. So that's usually bonds and treasury bonds and securities. The recent controversy arose because some Republicans wanted to put a stop to increasing government debt, which currently sits at around $16.7 trillion. Now that spooked the markets because to continue to meet its obligations in the form of interest payments to bondholders, public service and military salaries, Social Security, Medicare and the like, the US government needs to borrow more. If it can't, it faces the prospect of going into default. Now that's going to leave its creditors out of pocket. It's going to downgrade US credit rating. Most fundamentally, though, it's going to shake the whole foundation principles of international investors, including governments like China, who rely on US bonds as a benchmark risk-free investment. Now, frankly, in our view, coverage of this crisis was frequently coloured by commentators' political views. The fact is, though, that this controversy is not new. Debt limit has already been increased by Congress 10 times since 2001, prior to this crisis. Furthermore, it's been raised, definitions have been extended, or the debt limit definitions have been revised 78 times since 1960. So what do we see out of the most recent controversy? Look, a solution was released, but it's only temporary. By 7 February next year, the debt limit's going to be re-examined. What does that mean for investors? It's difficult to say. We're in uncharted territory, and US Treasury bondholders are frankly going to have to make some hard choices. From our point of view, this only emphasises our long-held view about the fallacy of the risk-free investment. All investments bear risk. That's a view we hold very strongly at La Trobe Financial. Turning now to La Trobe Financial as a group, and frankly we're seeing strength on both sides of the balance sheet, and that's going to allow us to capitalise on opportunities that we're seeing in the market. So the La Trobe Financial Group is sitting with net assets of $65 million at 30 September 2013. We've got FUM of $1.3 billion, which is growth of 8.4% year on year. We've recently commenced a new institutional mandate from one of the largest banks in Australia of $400 million, so that's really pleasing and a real fillip to our institutional lending side. We have employment remaining steady at 123 staff, and we've had a really active year in terms of portfolio assistance. We have assisted 4 other operators in transition on their portfolios, totaling $104 million for financial year 2013, and already, as the first quarter of this new financial year, we've assisted an operator with a $79.7 million portfolio transition. This is really confirming our position as one of the premier investment specialists in this area of the market. So that's very pleasing for us. Just as pleasingly, on the retail side, we have expanded our retail footprint. We're now covering some 10,000 retail investor clients across Australia. So really good, broad investor profile, and something that we're very pleased about. Looking forward, by popular demand, we launched a new website and investor portal. That's really receiving great feedback from investors. It showcases our investment expertise on our website, obviously highlights our thinking on key investment issues, and I'd invite you all, if you haven't already, to visit it at latrobefinancial.com.au. The investor portal, via an easy and intuitive registration process, allows you as an investor to view your investment balance online. We're going to be incrementally increasing its functionality in coming months based on the feedback we're receiving from you, so we look forward to announcing these developments to you as they occur. We also continue with our monthly investment insights email. If you haven't already signed up for that, I would certainly invite you to do so. We'd be delighted to have you part of the conversation. And we've got our investor sales desk who are really enhancing and increasing their activities. We're looking to call every investor on a bi-monthly basis as part of a really targeted investor communications and transparency program. So really looking forward to that really getting traction. Focusing now to our retail fund offerings and their performance over the last quarter. Now, I'll just give a very quick refresher. Our retail investment operations commenced in the 1990s and were built around the lessons we learned from managing large institutional mandates from some of Australia's largest bank and global investment houses. The fund aims to provide investors, obviously with very reliable returns, with a really strong emphasis on risk reduction via diversification. That's a real key for us. Now we have industrial strength asset selection, we've got industrial strength management processes, and we've got 60 years of portfolio management experience. Our fund pays monthly income, and in the pooled options, obviously this can be reinvested, which gets you the compounding effect, the miracle of compound interest. The fund is structured in a very simple way. There are 4 options in the one fund. All 4 are segregated from each other, so an investor in one option is not affected by the investment decision in another option. The options can be divided into 2 pooled and 2 contributory options. The contributory options, which you can see on your screen as the direct and high yield options, these allow investors to choose the individual loans in which they're investing. Our pooled options are more like your traditional mortgage funds, but obviously with some important differences. The cash and mortgages option, or CMO, is a segregated pool of cash, benchmark holding 35%. Also holds mortgages. It pays a variable rate of return that is currently 4.2% per annum. Got to stress, we're not after hot money in this account. It was started as a holding vehicle for investors who were between direct investments. The pool mortgages option is the group flagship retail offering. It's got 240 million in funds under management, holds independent ratings from houses like Zenith, where it holds a recommended rating, and SQM Research, where it holds a 4-star rating, only mortgage fund in Australia to do so. It has been Money Magazine's best mortgage fund in Australia for the last 4 years. It's a genuine 12-month term investment. Investors in the pool mortgages option also benefit from a dedicated investor reserve, which we generate from income from the pool. We set that aside solely to benefit investors by smoothing monthly income and also by meeting any shortfalls on individual loans. So that's an important part of the reason why no investor in the pool mortgages option has ever suffered a cent of capital loss. In reporting returns, we focus obviously on the 2 pooled options, being the CMO and PMO, cash and mortgages and pool mortgages options. As you can see, across the last quarter, the CMO delivered an annualised return to investors of 4.37% per annum. The 12-month term investment pooled mortgages option, or PMO, delivered 6.25% per annum. This equates to a margin over benchmark, or an outperformance, of 1.7% for CMO and 2.13% for PMO. So that's a really powerful outperformance. Also provided the longer-term performance of the options to highlight their extraordinary consistency over time. So I have to say that whilst ASIC tell us, and we agree, that past performance is no guarantee of future performance, this sort of profile that you see on screen is what we're trying to achieve for our investors. So we're extremely pleased to present it to you. Drilling down graphically, we can see the PMO's return against various 12-month term deposit indices. Over the quarter, PMO averaged a margin of 2.75%, outperformance of 2.75%, over the average 12-month TD rate of the big 4 banks. Obviously extremely powerful yield-based performance for investors. Similarly, you can see the CMO's returns in comparison to key online account indices. Now I stress again, we do not chase hot money for CMO, but you can see its strong and competitive performance in comparison to the top online accounts. Obviously I should note too that like the rest of the fund, the CMO is not a bank deposit nor subject to the government deposit guarantee. Concluding on performance, as we always do, we like to finish with our 2 favourite charts. The first is the PMO's annualised return since inception against other key asset classes, so cash, equities, bonds, etc. The PMO is that orange line running straight through the middle of your screen. Now that, in a single picture, encapsulates what we're trying to deliver for our investors. Regular, reliable income that's uncorrelated to other markets. It doesn't move when other markets move, and it also avoids the volatilities that hit some other asset classes so hard. So when you see the share markets dip, we are aiming that the pooled mortgages option continue to be that reliable part of your investment portfolio. When considered on an accumulation basis, that sort of performance produces a really strong absolute return. Now, obviously, to be frank, the pooled mortgages option was not designed to outperform equities over the long term, but when you deliver strong monthly returns so consistently, the numbers do begin to add up, and that's frankly what this graph shows, right through to the end of September from inception. So to summarise what we've covered today, our house view, the Australian economy is stable, but with some movement on the upside required. The world economic engines such as the US are growing. Interest rates are likely to be low for an extended period. We don't see a really significant movement in official cash rates, although we expect that the next movement may well be up. We see world growth subdued for the foreseeable future. It could, it's been much talked about. We may well be seeing low growth as the new normal. Having said that, we have a really strong and sound asset class. Australian housing is not in a bubble. La Trobe Financial is sound and really positioned well to take advantage of all the opportunities that are presenting in the market at the moment. And investment in our retail offerings continues to produce outperformance for our investors. I can predict we probably won't return 50% for our investors in the year ahead, but you've seen our performance history, so you know what we can do. On that note, I'll conclude the formal presentation. I'll use the time available now to turn to your questions. Again, apologies in advance if I don't get to yours, but I undertake to follow up personally after the conference is concluded. And if we just turn to the technology, we have a question here from Dorothy in WA. What is your view on arrears? Thanks, Dorothy. Look, frankly, our view on arrears is coloured both by what we're seeing in the economy and what we're seeing in the performance of our portfolios. Frankly, it's been extremely stable in recent years. We've got solid deleveraged borrowers. We've probably all seen the chart showing record savings rates. Really, the Australian household now is now saving at a rate that hasn't been seen in Australia since the mid-1980s. So we've got really strong deleveraged borrowers. Obviously, if unemployment increases dramatically, you can expect to see a moderate uptick in arrears. If borrowers lose their jobs, they will find it more difficult to service their loans, but nothing currently gives us significant concern. I should point out here at this point that we have a full report on our portfolio arrears in our monthly metrics on our website, so probably more detail than you ever wanted to know about our arrears, but we'd be delighted if you could avail of yourself of the opportunity to review those statistics. Okay, next question is Neil from New South Wales. Wants to know the effect of self-managed super funds on property values in the light of recent media comment. Look, it has been discussed a lot in the media lately, whether the self-managed super fund sector and in particular the ability of self-managed super funds to borrow and invest in housing is going to cause a bubble in the property market. It was raised by the RBA in their September Financial Stability Review when they made a pretty uncontroversial statement about the self-managed super fund sector now being a new driver and a new vehicle for potentially speculative investment, I think they call it, in the property market. On the back of this, obviously some commentators jumped on and said the RBA was saying that self-managed super funds were causing a bubble in the property market. Really, the figures don't bear this out. Now, we covered this, I think, in a recent edition of Investment News, but frankly, at the moment, self-managed super fund exposures to property are almost exactly in line with the exposures of the large superannuation funds. And they have really small holdings in the residential property sector. So residential property is just 3.5% of all self-managed super fund assets. So we've had borrowing permitted in self-managed super funds for 6 years, and we have less than 1% of assets of self-managed super funds being geared assets. So we're not seeing waves of demand by any stretch of the imagination. Obviously, we need to continue to watch the sector carefully. It's an opportunity for some property spookers, perhaps jumping on the back of what they see as a new opportunity in the market to pressure people as high-powered salespeople, to pressure SMSF members into residential property investment, but we don't see it at any macro level causing any significant fluctuations in residential property values. With that, I believe we're out of time. Thank you very much for your attendance. We've really appreciated that, and we look forward to continuing these investor call program teleconferences each quarter. We really look forward to having your attendance again at our next, which will be in late January. Until then, best wishes and happy investing. Thanks very much.